We have never seen anything like the housing market in 2023 in the history of the United States. There are a record number of homes that are owned by people who do not occupy them. According to CoreLogic, there are anywhere between 20 and 30 million single-family homes in America that are owned by investors. That accounts for 25% of all single-family homes in the country. Believe it or not, during the housing crash of 2008, we had a higher number of people living as primary occupants in the home than we do now. In investor-driven housing markets, that could result in a situation similar to subprime 2.0, where investors suddenly start selling. Investors dominate markets in Atlanta, Charlotte, Tampa, Phoenix, and Vegas, where in some zip codes, investors own between 50 and 60% of the homes. A lot of people seem to believe institutional ownership is the reason why there is such a large percentage of housing stock in some neighborhoods. People think that institutional ownership guarantees there won't be a crash. The theory is that these powerful, evil investors like Blackstone will never sell. People mistakenly believe that institutional investors are these all-knowing, all-powerful beings, but that's not the case. When you consider their cost of capital, which is currently 5.6%, many of them are purchasing and owning properties at a loss. Therefore, many of these investors are already losing money, not just because the appreciation is declining, but also because of the lack of cash flow after paying their lender. It brings home the fact that today's overpriced housing market is largely the result of artificially low interest rates, not just during the pandemic, but also for 5 to 6 years before it. They raised values by artificially lowering mortgage interest rates. Now that the interest rates have significantly increased, it's clear that the current real estate market is a bleeding venture. This leads to what I believe is the biggest story in the housing market right now, which is the declining rental market. Apartment construction is at a 50-year high, and 2023 will be the busiest year ever for new apartment completions. Many apartment developers decided to go all in after seeing the enormous 20% rent growth in 2021. The last 2 months of 2022 saw some of the largest rent decreases in a decade. They didn't anticipate that the rent growth wasn't legitimate and wasn't going to last. They are currently constructing apartments, which takes 18 to 24 months from the time of initial permit to completion. So the delivery of these apartments will continue. Investors face a significant challenge if this trend keeps up because they're unsure of how much to pay or how to purchase an asset. After all, they're unsure of what they'll be able to rent it for the following day. Single-family homes are a little different because over the past 6 months, we've seen builders scale back a little on single-family home construction. It's somewhat easier for them to abandon a project. However, once construction begins on an apartment building, the entire complex has to be completed. One of these boomtowns is Nashville, Tennessee. Only a year after opening, brand new apartments have 50% of their units vacant. A lot of them are currently offering 2 months rent-free, yet you still see the cranes building new structures. The fact that in some markets the cost of rent is determined by an algorithm is another worrying component. RealPage is the preferred management system for most properties. RealPage will merely suggest what the rent should be for that day. So rents change every day based on what rents are elsewhere in the city. This algorithm makes the decline in rents in a downturn even more pronounced. As a result, investors are buying and selling houses based on figures generated by questionable methods. This can create a more volatile market in the future. So why do rapidly declining rent prices matter? If you're considering purchasing a home, this essentially means that there isn't enough demand in the housing market as a whole. Renters will take advantage of falling rents during a recession, depriving the market of buyers in the future. There's a misconception that there's an oversupply of houses. This narrative is fueled by a study commissioned by the National Association of Realtors, which found that we underbuilt by 5 million homes over the last 20 years. However, that analysis ignores demand. They only focus on supply and housing unit construction, concluding correctly that housing construction in the last 20 years was significantly lower than in the prior 20 years. From a structural perspective, demand is much lower because American population growth has slowed down over the past 10 years. Another factor is that senior citizens occupy 25% of the housing units. Unfortunately, as seniors potentially pass away or enter nursing homes, inventory will continue to rise. This will exacerbate the problem because only 10% of the housing stock in the United States is occupied by young adults under 30. So, what's the takeaway? The takeaway is that the housing market is on the brink of collapse. There aren't enough people to fill these housing units at these prices overall, so those costs will need to drop significantly. In addition to being fueled by high interest rates, this housing crisis is also being fueled by the influx of investors. If you find the content in this video valuable, please like, share, and subscribe to the channel for information on investing.